Welcome back to The Explainer. Today, we're unpacking something pretty wild, the multidimensional reality of cryptocurrency investing. You see, crypto really isn't just a financial asset anymore. It's this profound collision of technology, human psychology, heavy-duty cybersecurity, and some incredibly complex legal frameworks. We're going to look way beyond the basic headlines today and explore the actual data behind why people invest, how they protect it, and the surprisingly intense legal realities of actually owning it.
Okay, let's dive right into this. Imagine you took a single $100 bill 15 years ago and put it into Bitcoin. Today, that exact same $100 would have transformed into a staggering $30 million. It's a number so astronomical, it literally feels like a typo, right? But it's the mathematical reality of the world's most famous digital asset.
In this explainer, here is our roadmap. We're covering 1. The mythical returns and risks. 2. Who influences your crypto choices. 3. Safeguarding your digital assets. And 4. Legal nightmares of self-custody. Let's get started.
Section 1. The mythical returns and risks. First up, we need to look at the raw historical data to see exactly how crypto stacks up against traditional financial markets over the long haul. And this brilliantly illustrates just how crazy that scale is. If you put that same $100 into the S&P 500 15 years ago, you'd have a very respectable $537 today. But compared to Bitcoin's 30 million, you're looking at an incomprehensible 68,000 times higher return for the cryptocurrency. But, to really get those numbers, we have to zoom out and look at the macroeconomic context. Over that exact same 15-year stretch, the US dollar lost 32.1% of its purchasing power thanks to inflation. And when you pair that with a national debt that's ballooned past $39 trillion, it makes total sense why investors have historically flocked to fixed supply assets like Bitcoin. It's often viewed as a hedge against an expanding money supply. But here's the catch. Those massive returns, they demand an incredibly heavy toll. While the S&P 500 saw a max drawdown or a drop from its peak of about 34% over this period, Bitcoin has suffered a brutal 93% crash. In fact, Bitcoin's volatility is 4 to 5 times higher than the S&P 500. Bear markets where you lose 80% or more are just historically normal in crypto. Talk about a massive test of an investor's patience and emotional control, right? Which brings us to a really fascinating question. Section 2. Who influences your crypto choices? Why do we actually choose to buy such deeply volatile assets? Let's dig into the behavioral science behind our decisions. There's this great study published in MDPI that analyzed where investors get their advice and how it impacts them. They found a really stark divide. Traditional financial professionals are constantly emphasizing risk and caution, which, no surprise, actually reduces the likelihood of their clients investing in crypto. On the flip side, you have media and social networks. They act like massive echo chambers, dramatically amplifying the success stories and driving huge waves of optimism and intent to invest. So how exactly does all that noise shape your mindset? Well, the data shows that high investor confidence heavily boosts the likelihood of jumping into the market. But the moment an investor has a heightened perception of the risks involved, that likelihood drops right off a cliff. Interestingly enough, the study found that the more varied your information sources are, like mixing professional advice with media, the more likely you are to at least state an intention to invest down the road. Basically, you feel like you've gathered enough data to reduce your uncertainty.
Okay, so let's say your research actually convinces you to take the plunge. That brings us to Section 3. Safeguarding your digital assets, because now you face the non-negotiable responsibility of protecting those assets from highly sophisticated cyber criminals.
Now, what's really interesting about this slide is the clear distinction in how you store your coins. According to cybersecurity experts at EC Council University, you basically have hot wallets and cold wallets. Hot wallets live online. They are super convenient for daily trading, but inherently vulnerable to hacking. Cold wallets, on the other hand, are physical hardware devices that store your keys completely offline. They act as a highly secure digital vault. To actually lock down your wealth, the EC Council recommends a multifaceted approach. Step 1. Keep the bulk of your funds in those offline cold wallets. Step 2. Enable two-factor authentication absolutely everywhere. Step 3. Relentlessly secure your 24-word seed phrase. That is the ultimate master password to your funds. And step 4, for larger holdings, you should really consider a multi-signature wallet, which requires multiple different keys to authorize just a single transaction. It adds massive redundancy to your setup. But taking total control of your own security introduces some seriously complex real-world consequences. Welcome to Section 4,
legal nightmares of self-custody. We have to explore what happens when the unbreakable security of holding your own keys clashes with human realities, like death and divorce.
Legal experts at the Knowledge Group highlight this foundational rule. In the eyes of the law, hardware wallets are treated a lot like bearer bonds. Possession basically equals ownership. Whoever holds the physical hardware device, or more importantly that 24-word seed phrase, legally controls the asset. Without those keys, even a court order literally cannot force a blockchain to hand over the funds acquired beforehand. Because crypto is pseudonymous, lawyers are now regularly using forensic blockchain analysis to trace premarital deposits and hidden transfers just to settle these intense disputes.
So the crucial point is this: what actually happens when a crypto holder passes away? Believe it or not, an estimated $240 billion of wealth is currently locked forever in what experts call digital graveyards. Why? Because 95% of crypto holders die without a clear succession plan. If you're forever.
Avoiding this nightmare requires highly proactive estate planning. Standard paper wills often fail completely for digital assets. You need specific digital asset clauses. You absolutely need your 24-word seed phrase backed up on fireproof metal seed plates, not just paper. And for ultimate security, legal and tech experts recommend Shamir secret sharing. This is where your master key is mathematically broken into pieces and given to 3 different fiduciaries. At least 2 of them have to come together to unlock the estate.
Which leaves us with this final provocative thought. Cryptocurrency offers historically unprecedented returns, and honestly, the revolutionary ability to truly own your own money without needing a bank. But that freedom comes at a steep price. You are now your own portfolio manager, your own cybersecurity firm, and your own estate planner. You hold the keys to your wealth, but are you truly prepared for the responsibility? Think on that, and we'll
Thank you for watching this video. Please subscribe this channel.